With Apple under pressure, are there any hopes of a major year-end rally going up in smoke? Let's ask the chart master, Carter Worth, over at the Plaza to break it all down. Carter.
Well, let's look at Apple first. I think Tim really nailed it. It's not about anything other than this is a money flow issue. All of these stocks ascended together, and they're all selling off together. We know Apple down in the aftermarket, so are many stocks that might be impacted by so-called trade wars. But let's just look at the chart itself and talk about Apple. I mean, Apple is down peak to trough 27%. Amazon's down 30. Netflix is down 40. Facebook 42. Google 22. FANG 25. Meaning it's all the same shape and trajectory. Great ascents and then important givebacks. I'm not sure there's anything specific or idiosyncratic about Apple, but one thing we do know is that it is a pretty extreme sell-off to a level of support. Now, support sort of starts here, if you will, and support is not a plywood board or a concrete floor, it's a mattress top. You sink into support. We are well into support. I think it's a better buy than a sell. I'm with you on that, Karen. The market. So year-end rallies, you know, that's just numerology in many ways to say something's gone up 40 out of 60 years. Unless there are 200 inputs or more, statistically you start to just get into randomness. In terms of the S&P, one thing we know, it was something of a well-defined double top or bull trap. Let's put in some lines, but first, let's talk about the facts. Numerology or not, December is typically a good month, 1928 to present. Average performance 1.4, median performance 1.49. So let's say it's that. Let's pretend it's double that. How about if it's triple that? Does that fix the market? Well, the issue is the market, even considering the precondition, not so good. So this is when the S&P is down going into December double digits. Now it changes the numbers. It's actually an average return in December of negative and a median that's unch. So we have a precondition of weakness that's unhappy. But in terms of getting back to the high, there's our double top. You could draw the lines that way. You could draw the lines this way. A break in trend. You could put it all together. You can call it whatever you want to call it. But what we do know is we'd have to climb back about 11% plus minus just to get to the high. So we go up 1.5, the average or median, 3, 5. The chances of making the high by the end of the year are basically nothing to talk about. Mathematically, almost impossible. Can we climb back there eventually? Sure. But the bigger issue is surely that this is all the look of a topping formation. It's been going on for a long time. I think rallies like this, we've seen plenty of them, are opportunities to reduce exposure to equities.
Carter, come on over. Stephanie will bring the chair in. Thanks, Stephanie.
35 cents. You're doing your work.
I listen so that the chart maestro master knows that I'm paying attention.
Can we go back to the Apple chart? You said it's a better buy than sell here. When you were drawing the mattress, the top and then the bottom of the mattress, it looked like the line was going to the bottom of that line.
Do we need to hold?
It's a cheap mattress,
do we need to hold the box spring level?
You shouldn't sink that far into it. But as you know, a kid bouncing on a bed, and at some point you find support. The point about support is it's not a, wow, this is it. You can sink into support. At some point, you find support. I think you're well into support. I would rather buy it here, then let's take the proof by contradiction. Fresh new shorts in Apple here? Not so sure.
But you're not, it doesn't take time to be convinced that it will hold that box spring sort of level and not slice through it.
Just keep knifing through it. You can stabilize, not ultimately bounce well, and then undercut. But on a straight down shot like that, you do get some sort of tension to rebound.
So I hope your question involves memory foam, because I think it's actually a great metaphor. Continue.
Thanks, Tim. It doesn't. So back in 2012, Apple was a huge outperformer to the market. We had a bull market, and the stock sold off 45% peak to trough into 2013. Same thing, 15 to 16. It had a 33% peak to trough decline. Here we are now. It's a little less than 30. But this stock was up 50% from its 2018 lows at one point. So to me, resting into your foam or whatever, 150 looks like that number. You can be wrong by 10% easily.
Sure. I guess the issue is this: when you just tick lower every session, it's a dangerous game. That's why we call it catch the falling knife. It's dangerous. At some point, though, you do get a ricochet more often than not. Take oil. Look, I sat on this very seat making the case to buy, again, went considerably lower. At some point, even if oil were to be cut in half, you get a counter trend move. I think Apple is setting up for that kind of thing.
All right. Carter, thank you.
Thanks, guys.
Carter Braxtonworth of Cornerstone Macro.
Brings it.
Always.
Going back to President Trump's comments, I wonder, has he been saving apples? Like, is that one of the arrows in his quiver? Is the timing somewhat interesting ahead of this meeting? And does he feel that using Apple will be the defining moment or the last straw to get a deal done with the Chinese? So I actually look at this as somewhat positive for a potential deal. I have no idea, quite frankly, but that's the way I would look at it. With that said, I agree with Carter. I still think in the S&P we have to trade down to that 25-30 level sooner rather than later.
February lows.